Welcome back to Lamb's Cryptoverse. If you like what you're watching, please stamp on that like button and subscribe button. This way we can continue these videos. So today I want to clear up some contradictions going on around interest rates, CPI, and the market. First of all, the market was up like crazy today. It was up like between 2 and 3%. This is Friday, October 21st. Why? Because the market's looking yet again for a Fed pivot. Folks, that ain't happening for a while. Why? Because the Fed's looking at lagged data, and that's the lagged CPI. But there's another issue I want to talk to you about besides that. It's that there's a lot of contradictory data with what inflation really is and whether or not there's been peaking inflation. So I'm going to play you Jeremy Siegel. He wrote a great book, Stocks for the Long Run. Highly recommend you read it. I didn't get paid to say that. And listen to what he's saying. He's basically talking about, first of all, that he said earlier, I'm not going to play it for you. Basically, he said that the Fed was way, like a year too late to raise rates. They waited a long time. You know about that already. But what he also said is that if real inflation already peaked. Now, listen carefully to what he's saying.
I understand that. On the ground, not the official statistics. On the ground, prices have slowed dramatically. And I would like him to acknowledge that we're looking at some forward-looking indicators rather than not even specifying which indicators he's looking at. Now, you're right.
Okay, the guy's getting all riled up, as you can see. Well, he reminds me a little of Bernie Sanders, doesn't he? So basically, he's saying that, like I said earlier, the Fed's looking at lagged data, not forward data, and he's only looking, basically, he's saying the Fed, he didn't say it specifically, but with the Fed, tends to look at the two inflation indicators, the PCE, which is personal consumption expenditures, and the one everyone knows about, the CPI. But the thing is, there are many other indicators of inflation, and I wrote them down for you so you could see the list right here. Basically, we have the movements of our currency. If the currency is strong, you're not going to have much inflation. And we're seeing that with Switzerland, even the United States. Our currency, as measured by the Dixie, DXY, it's like the strongest it's been in about 20 years against the larger G20 currencies. Like Japan, for example, we're at a 32-year high of the US dollar versus the Japanese yen. As you know, we went below parity in the euro. So the strong US dollar alone tells you that there isn't that much inflation. Then there's the price of gold, the price of real assets, and you can see now housing prices are starting to come down. And next week the S&P Case-Shiller index is coming down. You're probably going to see a dramatic decline, at least more than expected. And then there's the ones I mentioned, the CPI, there's a PPI, the Producer Price Index, the PCE, and then the one the Fed does consider, and that's the trend inflation indicators. Basically, they get rid of all the bad stuff. They get rid of the highest and lowest components that increased or decreased that overall inflation rate. And then there's core inflation, core PPI, core CPI. Basically, that excludes food and energy. Then you have one that nobody looks like that, but actually affected the stock market the last time it came out. And that was the University of Michigan Consumer Confidence Survey. They also give a survey on inflation, and that affected the market because consumers are starting to say they're worried about inflation and they're projecting a higher inflation rate. But then there's other inflation rates that people don't talk about. There's the TIPS, the Treasury Inflated Protected Securities. There's a forward inflation expectation rate. That's basically the 5-year forward rate on 5-year bonds, something like that. It brings me back to my FRM days when I had to calculate what today's rate would be based on forward rates, some crazy calculation, basically. And then lastly, similar countries. If you're not sure if this rate for the United States is real, it's about 8.2%, the CPI. If that doesn't make sense to you, you can actually go to other countries and see what similar countries have similar deficits, similar currencies, and similar trade, and you can see how they're doing. So what I want to point to you today is that it's possible that two things. Number one, it's possible that the 10-year rate and longer term rates can go up, but not because of inflation. What we're seeing now is potential market dysfunction. And Market Watch mentioned this in one of their news stories. Today they mentioned that the 2-year Treasury yield, for example, had its biggest weekly drop since July. No one's talking about that. Why? Because the 10-year yields and the 30-year yields are not doing well. And you can see right here, the 30-year yield actually went up today, 12 basis points. But if you look at the other yields, they went down, like the 2-year yield went down. So something's wrong. That's not what I was expecting and predicting. I was saying that there was going to be an inversion in the yield curve, and we do have an inversion in the yield curve. And you can see here, this is the yield curve from last year and this year as of today's date. And you could see it was steep a year ago in 2021, and now it's flattening out. However, I expected, here's where I I want to say slight error. I don't want, maybe I'm being too modest. Basically, or maybe I'm not being modest enough. Basically, what I want to say is I thought the 2-year rate would be even much higher than the 30-year rate. Now let's be clear. The 210 spread and the 32 spread, basically the 230 and the 210 spreads, they're some of the widest they've been in history, but they've been higher, and that's what I was expecting. And why, here's what you need to know that they're not telling you. Why long-term rates could go higher is because there's a potential liquidity and market dysfunction going on. And we saw that happen with the UK when there was a potential blow-up in the UK pension funds. You saw a big increase in UK bond rates. And I hate to tell you, that affects our rates. And the other issue is if foreign currencies are crashing, and they are crashing, what they do is the treasuries there, what they do is they sell their investments, and they happen to be in U.S. treasuries. So when you're selling U.S. treasuries, and they tend to hold longer term treasuries too because they want the yield. So when you sell the treasuries, that lower demand, that supply coming on the market basically pushes rates higher. So we have two kind of interrelated market dysfunctions pushing up longer term rates more than they should be. Now, why should rates be lower? Because I'm going to show you right now, there are some other examples of inflation. I showed you them before, the CPI, whatever. But there's other ones that are indicating that we've already peaked in terms of inflation. So let's see if I can find these here. First one, before we go to that, this is the 10-year yield. You can see it's soaring. And the end here, this is the last months. This big increase happened to coincide with the craziness going on in the UK. But I want to focus more, and here's the CPI index, it's at 8%. So I want to show you more areas where it's peaking. This is the one that most people look at, the CPI. Notice you don't get too many little peaks where it goes up again. You tend to get one big peak and then it goes down. Now look at 1951, peak and then down. And then over here, 1974, peak and then down. 1980, the Volcker years, peak and then went down. And I think now, if you look over the last month or two, that's what we've had. We've already had a peak. Now, this is not what I want to focus on. This is the CPI that everyone looks at. I want to show you that it's peaking if you look at other indicators. Let me give you some example. This is a 5-year break-even rate. The 5-year break-even inflation rate, it's already peaked as of March. So look at that. It's already been peaking for months. And then we've got something else. And I mentioned the forward rate. This is a 5-year forward rate. I'm not going to explain that to you, but it's tied to the tips. And basically it shows you that inflation peaked way back in April 22. See a trend there? And well, this is countries, and I just want to show you that the United States is about where it should be in terms of countries. So if you see that United States at 20%, that would make sense because similar countries have lower than 20%. And you can see we have 8.2%, and the Euro area has 9 and 10%, but they have issues with energy, and we don't. So our inflation, if you look at this, should be lower. So that was another chart I wanted to show you. So I showed you a few. And I think I'm going to show you one last chart. This is a really cool chart. This company, Truflation.com, is used by Web3 devs. And it's connected to Chainlink, for example. Oracle on a layer one Oracle, basically. No, is it? I'm not sure if it's called a layer one, but basically it's an Oracle that gives information on chain on to smart contracts, and that's Chainlink. So, and it's related. It's connected to other uh, level one and level two blockchains. So this is a good one to use, and it's also good to use because it's daily and uses other ways of measuring inflation. So the key point here wasn't to talk about Chainlink, but it's an interesting fact. It was this. I wanted to show you that, guess what? Maybe I should make this smaller so you can see it better. Oh, did I lose? Here it is. Guess what? It peaked in March of 2022, and it's been going down. As a matter of fact, we're at the lowest inflation rate we've been over the last year. How do I know that? If you look at the left side here, it says lowest it has been today, October 21st, and the highest was at 12%, which was probably around February and March of 2022. So you can see all this information is showing that inflation has already peaked. So I'm going to show you once again, because there's a lot to review. There was the yield curve, which usually, when it inverts, usually implies that inflation is peaking. And then I showed you the CPI, which is peaking. I showed you a 5-year break-even rate, which is based on Treasury inflation-protected securities, also known as TIPS. And I showed you the 5-year forward inflation rate. And I showed you what our inflation is compared to other countries. And then lastly, I showed you Truflation's inflation rate. So what all this means is, now listen carefully, it means this. One, that inflation has already peaked, and we're probably going towards a recession. And we talked about this already. ISM manufacturing index has already peaked and is coming down fast. The only problem we have is wages. So the Federal Reserve needs to, I hate to say this, destroy jobs. That's the only way they're going to get rid of sticky inflation. So the other thing I want to say is that the Fed, unfortunately, is looking at lagged data. They're not looking at this historical Truflation rate, as it's called. They're looking at the PCE. So when you hear CNBC people, advisors, and talking heads, and people in Market Watch and Yahoo Finance, when they say markets are going up because we're nearing a Fed pivot, that is not true. The Fed is not going to pivot anytime soon, but it will cause a recession, and sooner or later, all rates, especially the 10-year rate and 30-year rate, will decline. Well, thank you all for listening, and please stamp us that like button.